This is our Forex blog for December 6, 2011. And like most days, we really want to buy the strongest of the currencies. We want to sell those that are the weakest. The real-time strength or weakness of each currency is on top in histogram form. This is made up of 5 different statistical trend tools we developed, averaged together. 3 of them measure the percentage of currencies going up or down. 1 of them measures the bar-by-bar intensity statistically, comparing how far each, let's say, dollar pair is moving compared to all the rest of them. If they're going up and they're going up with 150% more intensity than normal, then typically you'll have these things pegged out at 100%. A very high percentage of them going up with extreme intensity tends to mean that that trend will continue. You get a little bit of a pullback here for 20 minutes, then it goes up for 40 minutes, another pullback, and then that strength, continued again for the most part for 7 hours. And that's how you use our tools. Look at the last momentum move that had intensity, and if it's in the direction underneath the real-time momentum, we have the daily, weekly, and monthly. I prefer when the real-time momentum matches the daily and the weekly. In this case, we have a daily trend that's up, the weekly trend's down slightly, the monthly trend's up. So that's obviously a little bit harder to trade. When that's the situation, you should estimate smaller profit targets. Anticipate if you see some strength within weakness, maybe that strength will continue, but maybe only for an hour. You can see it went here for an hour, 15 minutes of weakness, another hour and a half of strength. Always estimate to the low side so that when you take a trade and risk, let's say 10 or 12 pips, if the profit target's only 10 pips, then don't take the trade. It's better to avoid trades that have lower odds than to lose money. There are some currencies that, like the Australian, the weekly monthly trend's up. You had a little bit of weakness before midnight, and then at 3 had some strength, very little weakness. The strength is likely to return back, especially since the weekly monthly trend are so strong to the upside. So same thing with the CAD. Weekly monthly trend strong. You can see mostly strength here. And when you see weakness come in, if the longer term trend is up, it's much less likely to continue for a long period of time. This intense weakness carried on, and then the weakness kind of disappeared because the longer time frame trend is up. It's likely to resort back to strength, and it does for pretty much 3 hours. So since this is the last one I went over, let's just compare it against ones that are weak. The Euro's weak on pretty much all time frames after 9. The Swiss is, and the pound is. So why not trade this strong CAD when the strength resumed against either the Swiss, Euro, or pound? So these are currencies that we don't typically leave running overnight. So we'll look at the CAD Swiss. This is very likely to go up. Strong CAD, weak Swiss after 9 o'clock. Let's take a look. Let me put this on layer 20. All right, so you can see after 9 o'clock this thing exploded up, and it was very strong before, pulled back, found a nice little solid base right here, and when it broke out, there was actually pretty high probability entry even before that. When its trend line got broken, it was previously strong. The CAD is one of 2 or 3 currencies that are pretty much up on all time frames, and this is the kind of thing that oftentimes happens. If you miss, this is a 5-minute chart. One thing that you can do is look at this on a range bar chart. We'll put in 6 pips per bar, hit enter. This is going to download tick data, and it's going to give us other entries that you can't find on minute-based charts. It's faster when you do this if you select less than 6 days of data. It's a lot of data to download. And so you can see on a range bar chart, there's some entries on this that you wouldn't have even found on a 5-minute chart. Here it went up, kind of pulled back. You have a little mini double bottom here. This is more of a scalping type entry. And then it took off. You also have this nice little pullback right here. And you have profit targets off of these swings to shoot for. If you buy this right here at 91.20, being one of the strongest currencies at the time, 44 is your profit target. That's 24 pips. You're going to risk maybe 8 to 10. So it makes it worthwhile. It's probably 70% likely to go to this profit target because it was one of the strongest ones, and all the time frames were saying to buy the CAD and sell the Swiss. And anytime you can take a trade that's even 50% or more likely to work with 1.5 to 2 times more likely profit than what your risk is. Your risk, once you buy this, is just 1 or 2 pips underneath this low right here. And so this tiny amount, 10 pips or so, once it goes up and kind of goes sideways, you want to move your stop to break even, or even underneath here and lock in a pip or two, and then it takes off. And if it stalled here, you get out of half and let your trailing stop go to the other half. But it continued. So most of the time, prices don't go to or above the 1.618, so you'd be out of the whole thing up here at 55. You bought this at 21, you got a 34 pip profit while risking 10 pips. And in a nutshell, that's the key behind our trading. If you take enough trades that are high probability and likely to give you many more pips than what your risk is, you should make money if you trade based on our tools and systems. Let's look at the pound. It's also weak on all time frames, not as weak as the Swiss, but we'll take a look at this. You want to sell the weak pound versus the strong CAD. And I'm going to go back to the 5-minute chart so we don't have to download data again. Pound CAD, very likely to go down, and as you can see at 9 o'clock it did, and you have some pullback trades on here as well. This is about a 25 pip pullback, and you also have this little pullback right here, which, by the way, you draw your fibs on the previous swing and you have your profit target. Look where it's stalled at. Is that a coincidence? No. Fib targets work probably 70–80% of the time. So this is a wonderful, if you sold here and here, this was your profit target both times. The first time you would have had a small 10–15 pip profit. The second one, it would have been a huge win. You're short maybe at 14 and out at around 50. So you made over 60 pips while risking maybe 15 pips on this. And just so you can see what it looks like, I'll bring up a range bar chart for this. We'll put up 6R for 6 pips per bar. And we have tools that let you know the proper amount of pips per bar for each currency depending on its volatility and time of the day. You can see here on a range bar chart, it's just phenomenal in terms of the better view of the market. Here it came down and you have a nice 3-bar pullback. You have an entry here that you wouldn't have had on a 5-minute chart. Range bar charts are vastly superior. If you're really aggressive and you miss the first pullback trade, you can also, I prefer 3 to 5 bar pullbacks. If this is set for this currency's volatility, the 3-bar pullback, 3+ bar pullback is phenomenal. It's a very high winning odds trade, but 2-bar pullbacks when the currencies this week are usually the most that you're going to get. Anytime you sell, you want to put your stop a pip or two above the high, and you can also hang on to these trades or get out of a scalp. It goes down, here's your first green bar, you put your stop a pip over here and you're out at 43, short at 63 for a 20 pip win. Same thing down here. Sell this right here, and you're out of this trade when it goes a pip over that green bar, which would be at 58.11 approximately. Oops. This trade right here would be about 30 pip profit. Now, when you risk 10 pips and you end up making 30 pips, today was a nice trending day in many of these pairs. Yesterday was, much harder, less trendy, more choppy in most of the pairs. Watch our classes to learn, some of the other more advanced methods that we teach. But I'll finish class today by focusing on the euro as well. Weak euro on most of the time frames. Strong CAD. So you want to sell the euro CAD, especially after 9 when the CAD became the strongest one and it was strong on all time frames. And if you miss that 9 o'clock move, here's 9 o'clock. Let's say you missed, this 20–30 pip drop here. You have opportunities to get into these trades. I prefer, like I said before, a 3-bar pullback. 6 pips per bar. This has nothing to do with time. Once it moves 6 pips, it starts a new bar, it moves 6 pips, and so forth. Now, some bars are bigger than 6 pips, and that's usually when there's news events out or the price gaps. If the market's moving and hasn't gone 6 pips yet and then gaps down 10, we're going to draw a big bar. So you can always see on the big bars that, there was a gap there. If one bar is bigger than all the other bars on your chart, you knew that price gapped there. And it just looks better than leaving the price open. But again, if you wait for, I prefer a 3-bar pullback here. You only have 2, but your stop is right above the high here. It goes down and kind of consolidates. You can always, every time it makes a lower low, yank your stop down above the little pullback area. And trends don't go forever. Here it kind of goes down. This is your second wave down. Most of the time, the third wave is the end of the move. So you should always draw your fibs on that second swing, second wave of the move. And guess where it went? To the pip, to the 1.618. So again, 1.618, the vast majority of the time is the most pips you're going to make. So you'll be out of your trade here at 36. If you shorted this and waited for the two waves, you have over 70 pip profit while risking 10 pips. Again, you should have a higher than 50% winning rate if you're using our software and trading methods right, and focus on trades that are likely to continue trending using our currency meter. And you will find that you occasionally get 30, 50, 80 pip moves, and your losses oftentimes are less than 10 pips because you're using trailing stops. And once the market moves up 10 pips, your 10 pip stop is pretty much at break even, so you don't really have much of a loss at all in some cases. So I'm going to start our regular class now.